So, what do you make of a company whose stock is just absolutely plummeting today? I mean, we're talking a really steep drop of over 9% to trade at just $1.17.
Oh, wow. Yeah, that's rough.
Right. But here is the kicker. If you actually peel back the layers of their latest financial filings, their core sales are somehow surging by double digits.
It really is the ultimate paradox in modern markets. Usually, you'd expect the scoreboard, like the stock price, to accurately reflect the reality of what's actually happening on the field.
Yeah, exactly.
But right now, looking at the data for this one, it feels like this company and Wall Street are just playing two entirely different sports.
They really are, and that is the massive disconnect we are diving into today for you. The company at the center of this whole mystery is Dragonfly Energy.
Which, if you're an outdoor enthusiast, you probably know them better by their flagship consumer brand.
Right. Battle-born batteries. They make these high-end lithium-ion power systems. And looking through our stack of sources for this deep dive today, which, includes their 2025 annual financials, the Q1 2026 earnings transcripts, recent acquisition press releases, and even insider trading logs. It's wild.
It's a lot to process.
It is.
Yeah.
Trying to build a cohesive narrative out of all that is honestly enough to give you whiplash.
It really is, yeah. I mean, the public markets have essentially priced this business as if it's, well, already in the graveyard. But then the company's own ledger is actively telling the story of aggressive growth and expansion.
So our mission for you on this deep dive is to basically unpack this contradiction. We need to figure out, is Dragonfly Energy just a doomed value trap?
Right, like a sinking ship that's temporarily tricking the market with a few flattering numbers.
Exactly. Or, on the flip side, are you looking at a high-reward turnaround story that is quietly positioning itself for a major inflection point?
It's such a fascinating puzzle because both the extreme bulls and the extreme bears actually have incredibly compelling evidence right now. It just depends on which line item of the financial statements you want to highlight.
Let's start by looking at the sheer ugliness of the stock chart compared to the underlying financials. Because, wow, the contrast is jarring.
Yeah, the chart is a total disaster.
It really is. The stock is hovering just a hair above its 52-week low of $1.12. If you zoom out, like over the last 26 weeks, it is down a staggering 68%.
Ouch.
And if you go all the way back to its 52-week high of $26.10, the stock is currently trading 95.5% below that peak.
I mean, those are just undeniable distress metrics. When a stock loses 95% of its value, the market is no longer signaling a slight earnings miss, right? It is signaling an existential crisis.
Yeah, they think it's over.
Pretty much.
Yeah.
If we look at the valuation multiples in the provided data, Dragonfly is trading at a price-to-sales ratio of 0.27 and a price-to-book ratio of 0.56.
Okay, for anyone listening who, doesn't spend their mornings staring at valuation multiples over coffee,
Yeah.
let's ground that price-to-sales ratio of 0.27 in reality. What does that actually mean?
Sure. So think of it like walking up to a local successful bakery that generates $100,000 a year in steady sales.
Okay.
And the owner just walks up and offers to sell you the entire business for $27,000.
Wait, really? That cheap?
Exactly. In the tech or clean energy space, a healthy, growing company might trade at a price-to-sales ratio of 3, 5, or even 10 times their revenue.
Right.
So a 0.27 ratio basically tells you that the broader market believes Dragonfly's revenue is effectively meaningless. Investors are betting that either the sales are going to completely evaporate or the company's debt and cash burn are just so severe that the revenue will never translate into actual profit for the shareholders.
So it is quite literally priced for bankruptcy.
Absolutely.
But then you flip the page in the sources to the 2025 financials. And this is where the narrative completely fractures for me. Because in 2025, their net sales actually increased 15.8% to reach $58.63 million.
Which is not a small number.
Not at all. Gross profit jumped 34.6%, and their gross margins expanded by 370 basis points.
Right, and just to translate those 370 basis points, that simply means their gross margin went up by 3.7%, landing at 26.7%.
Which is huge for them. It's like finding a heavily dented can at the grocery store only to open it up and discover it's packed with, gourmet soup.
That's a great way to put it.
How does a stock get priced for imminent death while the actual top-line revenue shows a definitive return to growth? And it's not just empty revenue, The gross profit is growing faster than the sales.
Yeah, that's the key part. That implies they're keeping more of every single dollar they make before paying for their overhead. And that margin expansion is usually like the holy grail for a manufacturing company. When we see a disconnect this severe, it usually means the market just doesn't trust the source of the revenue, or they simply don't believe the company has enough oxygen, meaning cash, to survive long enough for that revenue growth to actually matter.
Right. So to understand the market's pessimism, we really have to trace exactly where that $58 million is coming from.
Yes, which brings us to the massive tectonic shift happening beneath the surface of their sales figures.
Because if overall sales are up almost 16%, where are people finding the pessimism? The answer is in the breakdown of their two core markets, direct-to-consumer, or DTC, and original equipment manufacturers, or OEM.
This transition is, without a doubt, the most critical dynamic happening inside the company right now. Because Dragonfly built its initial reputation and brand equity entirely on that direct-to-consumer market.
The battle-born stuff.
Exactly. This was primarily individual consumers in the RV space buying those battle-born batteries to upgrade their personal rigs. But in 2025, that DTC revenue actually dropped 8.5%, falling down to $20.7 million.
And we know from the broader market data that this consumer drop is just entirely being dragged down by macroeconomic pressures. I mean, RV lifestyle is highly discretionary.
Very much so.
When interest rates are sitting at multi-year highs and inflation is just pinching everyday wallets, people simply aren't rushing out to finance a $100,000 RV, nor are they, eager to drop thousands of dollars upgrading their current setup with premium lithium-ion batteries.
Yeah, that consumer market is incredibly cyclical and super sensitive to interest rates. But here's the flip side of the coin. While that legacy consumer side is shrinking, their OEM sales, meaning Dragonfly, selling directly to the massive corporate entities that manufacture the vehicles and industrial equipment, those are absolutely skyrocketing.
Like off the charts.
Right. OEM net sales jumped 33.8% to $36.93 million in 2025. And importantly, that momentum didn't stall out. It carried right over into the first quarter of 2026, where OEM sales jumped another 30.1%.
I have to push back on this strategy, though.
Oh, really? How come?
Because, well, on paper, surging OEM sales sounds great. But if you are selling direct-to-consumer, you set the price. The margins are great. The moment you pivot and walk into a boardroom with a massive corporate vehicle manufacturer to secure an OEM contract, they hold all the cards.
That's a fair point.
Right. They demand massive volume discounts. So you are basically trading thousands of loyal, high-margin retail customers for a handful of giant corporate clients who can squeeze your margins to the bone. When a company's foundational market starts cracking, isn't this pivot incredibly risky?
It is a very common fear, and you're right that upfront margins can definitely face pressure in corporate negotiations. They negotiate hard. But in heavy manufacturing, you're trading that slight margin compression for a vastly stickier, more resilient competitive moat.
Okay, walk me through that. How does selling to a giant corporation build a better moat than having a cult-like consumer following?
It all comes down to engineering switching costs. Think about it. When a consumer buys a battery online, they might choose a different brand next time just because they, saw a targeted ad or a holiday discount. There's zero friction in switching.
Right. They just click a different button on Amazon.
Exactly. But when an RV manufacturer or a heavy trucking company integrates Dragonfly's battery system into their actual factory floor design, we are talking about custom wiring harnesses, specific spatial dimensions in the chassis, software communication protocols. They cannot just swap that out for a cheaper competitor on a whim.
I see. The batteries are actually talking to the vehicle's computer system.
They are. It fundamentally transitions Dragonfly from being just an aftermarket accessory you strap onto a bumper to being a critical piece of the vehicle's central nervous system.
That makes a lot of sense.
The engineering costs to rip that out and start over with a new battery supplier are massive. So while the retail consumer market is vulnerable to the daily moods of the economy, these OEM contracts lock in long-term, highly predictable revenue.
So management clearly views this pivot not as an act of desperation, but as a strategic necessity to survive.
100%.
And what's fascinating is that they aren't just sitting back hoping their existing RV partners order more batteries. They are actively trying to widen this new moat by replacing their lost consumer revenue with completely new industrial sectors.
Yeah, they are acting remarkably aggressively for a distressed company. Let's look at how they're attacking these new markets through recent acquisitions and partnerships, because it's pretty bold.
The recent acquisition of Dakota Lithium is the perfect example. According to the press releases, Dragonfly acquired Dakota Lithium's assets for a total of $4 million. Now, this deal brings them a historical $12 million revenue base, and it immediately parachutes Dragonfly into new sectors like marine, power sports, and even golf carts.
Which are huge markets for lithium.
Massive. But the most interesting part is how they paid for it. They only spent $1 million in actual cash. The remaining $3 million was paid in Dragonfly stock.
Yeah, let's break down the mechanics of that, because for a distressed company with severe liquidity issues, structuring the deal that way is honestly a masterstroke.
Wait, hold on though. Paying in stock when your stock is tanking down to $1.17, how does that even work?
I know, it sounds counterintuitive.
You're giving away a piece of the company at a historically low valuation. That has to be incredibly dilutive for the current shareholders.
Oh, it is painful dilution, without question. But when you are in a survival scenario, equity is basically the only currency you can print. By issuing stock for 75% of the purchase price, they preserve their most precious finite resource.
Which is actual cash in the bank.
Exactly. But the real genius of the Dakota Lithium deal isn't just the financing side of it, it's the operational leverage.
Meaning what, exactly?
It means management expects this acquisition to start contributing meaningful revenue without requiring a proportional increase in fixed overhead. They do not have to build a whole new factory for Dakota Lithium.
Oh, right. Because they already have the battery management systems, the assembly lines, the shipping logistics.
Exactly. Dakota just brings a new brand identity and a fresh customer list. It's like having a massive commercial kitchen that's only running at half capacity.
Okay, I like this analogy.
You can take on a whole new catering contract without having to pay extra rent or buy new industrial ovens. You just run more ingredients through the exact same system, and your profit margins on that new contract are significantly higher.
That makes total sense.
Yeah.
They're just utilizing the infrastructure they've already built and paid for. And this aggressive expansion isn't just limited to acquisitions. They have real validation happening in heavy-duty trucking right now.
Yes, the trucking sector is a massive opportunity for them.
The sources highlight a $3 million purchase order from Stevens Transport to outfit nearly 500 trucks. Plus, they secured a massive $30 million licensing and contract manufacturing agreement over 7 years with Stryten Energy.
That Stryten deal is huge.
But why is heavy trucking suddenly such a massive target for lithium-ion batteries?
It's all about what the industry calls hotel loads. Long-haul truckers need power in the cab while they are parked. Running the air conditioning, microwaves, medical devices, entertainment systems.
Right, because they essentially live in those cabs.
Exactly. And historically, they either idled the massive diesel engine, which burns expensive fuel and actually violates emission laws in a lot of states now, or they used heavy lead-acid batteries that die quickly and add massive weight to the truck.
And every pound of battery on an 18-wheeler is a pound of paying freight they can't haul.
Precisely. The macro transition from lead-acid to lithium-ion in industrial trucking is just a massive tailwind. Lithium is lighter, lasts significantly longer, and charges way faster.
And because Dragonfly has a track record of selling over 370,000 batteries since 2020, they actually have the proven brand equity. They can walk into a room with a massive logistics company like Stevens Transport and convince them to trust the power systems for an entire fleet.
Right, they aren't an unproven startup.
So let's tally this up. We have a company with surging, highly sticky OEM sales. They're executing brilliant, cheap acquisitions that utilize existing infrastructure. They are successfully expanding into the heavy trucking sector, and they have strong brand validation.
Sounds pretty great, right?
It does. Which brings us to the most uncomfortable part of the analysis. If this expansion strategy is so undeniably good, why is the stock at $1.17?
Because executing a massive operational pivot takes time, and rapid expansion costs immense amounts of capital. Right now, time and capital are exactly what Dragonfly is running out of.
Yeah, we have to dive into the cash burn and the liquidity risks now, because this is the terrifying reality the market is pricing in. I mean, it sounds like they are patching holes on a sinking ship while trying to build a new engine. Are they just going to run out of money before this master plan actually works?
That is the single most important question. The numbers from the financial statements are, frankly, sobering.
They really are.
Yeah.
They posted a devastating net loss of $69.9 million for 2025. In just the first quarter of 2026, they lost another $6.6 million. and their trailing 12-month net margin sits at a negative 126.9%.
Let's just pause on that negative 126.9% margin for a second so we fully grasp the severity of it.
Yeah, please do.
That metric means that for every single dollar they bring in from selling a battery, they're spending $2.26 to operate the business. You do not need a degree in advanced finance to know that math leads directly to a brick wall.
It's like they were trying to swap out a sputtering Cessna engine for a powerful jet engine while the plane is already in a steep nosedive.
That's a very vivid but accurate way to picture it.
They know the jet engine will eventually pull them out and send them higher. But the terrifying question for anyone looking at this stock is, do they have enough altitude before they hit the ground?
Exactly. It is a literal race against time. Management is fully aware of this altitude problem, which is why you see them engaging in can only be described as active financial triage.
Let's look at the mechanics of that triage. The filings show they recently had to amend their debt arrangements. First, they managed to get their lenders to lower the minimum cash covenant,
Which is basically the floor of cash they are legally required to keep in the bank just to avoid defaulting on the loan.
Right. Secondly, and this feels much more drastic, they got permission to pay the next 2 quarters of interest in kind rather than in actual cash.
Paying interest in kind, or PIK, is a critical detail that you really need to understand if you're watching this company. It means instead of sending a physical cash check to the lender every month for the interest owed, the lender simply takes that interest amount and tacks it onto the total principal debt.
So it's like calling up your credit card company and saying, hey, I can't afford the interest payment this month, just add it to my total balance.
Pretty much, yeah.
It saves your checking account today, but it's compounding your debt. Next month, you're going to be paying interest on a larger pile of money.
It is a compounding danger, yes, but it is a necessary evil for a company in this position. By doing this, Dragonfly preserves about $1 million in near-term liquidity over 2 quarters.
And $1 million might not sound like a lot of money for a publicly traded company.
But when you are burning cash this fast, every single dollar you keep in the bank is another day of oxygen while you try to swap that engine.
And they aren't just playing games with their debt structure. They are cutting expenses to the bone. In March 2026, they implemented a strategic cost realignment.
Which is a polite way of saying deep cuts.
Right. According to the filings, this painful restructuring is supposed to generate about $8.9 million in annualized savings.
This is where we see the specific finish line they are sprinting toward. Management has explicitly mapped out a target of reaching adjusted EBITDA profitability by the 4th quarter of 2026.
And just for clarity, adjusted EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Basically, it's a metric that asks, are the actual day-to-day operations of making and selling batteries generating a profit before the accountants and bankers take their cut?
Yes, it is a measure of core operational viability. Everything we just talked about, the debt amendment, the dangerous in-kind interest payments, the $8.9 million in deep cost cuts, the stock-heavy Dakota acquisition, every single one of those moves is designed for one singular purpose.
Buying runway.
Buying them enough runway to reach that Q4 2026 profitability target without going bankrupt first.
So with stakes this incredibly high, a brilliant operational pivot handcuffed by severe existential cash burn, how are people actually trading this stock? Let's follow the money and look at the market sentiment because the dynamics here are fascinating.
The first thing that stands out from the trading data is the volume. The recent sell-off that drove the stock down to its current level of $1.17 actually happened on very low volume, about 0.7 times the average daily trading volume.
Okay, what does low volume during a massive sell-off actually imply?
Well, when a stock plummets on massive, high volume, it usually means institutional investors, the mutual funds and hedge funds, are actively dumping their shares and running for the exits. There is high conviction in the selling.
Everyone wants out.
Right. But when a stock bleeds out on low volume, it often just means a lack of buyers. The market is exhausted. The big money is just waiting on the sidelines to see if the company survives the cash crunch.
But someone is buying. And this is the data point that completely caught my attention in the research. Net insider buying. Over the last 90 days, corporate insiders have bought 10,000 shares on the open market.
Yes, that is a huge detail.
And on the flip side, 0 sales. Not a single insider has sold a share in the last 3 months. the psychological weight of that is massive.
It raises an incredibly important point about informational asymmetry.
I mean, if you work on a ship that is taking on water, you don't generally buy more tickets for the cruise, right? You secure a spot in the lifeboat.
Yeah.
The fact that the people running the company are opening their own personal wallets while the stock is crashing toward $1, that screams that management legitimately believes they are going to survive and hit that Q4 profitability target.
It is arguably the most bullish signal in this entire data set. Management has a clearer view of the daily order book, the Dakota Lithium integration progress, and the exact cash runway than anyone analyzing the public filings.
They see the real numbers.
Exactly. However, we do need to look at the retail trading narrative surrounding this insider buying, because it has sparked intense speculation.
You're talking about the short squeeze rumors floating around the retail message boards.
I am. Because the stock is sitting 95.5% below its 52-week high, and because you have this documented insider conviction, a highly speculative narrative has taken hold. People think Dragonfly is prime for a massive short squeeze if any positive fundamental news drops.
And just to review the mechanics of that for a second, when investors bet against a stock, they borrow shares and sell them, hoping the price drops so they can buy them back cheaper.
Correct.
But if the company suddenly posts a surprise profit, those short sellers panic. They all rush to buy shares at the exact same time to return what they borrowed, which forces the price up like a geyser.
That is the theory, yes.
Right.
But it is crucial to understand that while the symptoms of a squeeze setup are present, a beaten down price and insider buying, the narrative is purely speculative.
We don't have all the facts.
Right. We don't have the explicit real-time short interest data to confirm exactly how heavily bet against this stock truly is. Furthermore, a short squeeze requires a catalyst. It relies on flawless operational execution by the company.
They still have to successfully swap the engine before the plane hits the ground.
That is the reality. Insider buying shows they believe in the Q4 target, but personal belief doesn't pay the lenders, only execution does.
So let's pull all of this together. We've taken a deep dive into Dragonfly Energy, and it truly is the ultimate high-risk, high-reward turnaround play.
Without a doubt.
You have a company trading at an absolute fraction of its revenue, battling severe cash burn that threatens its very existence. But on the other side of the ledger, they are armed with surging, highly resilient OEM growth. They're successfully breaking into the massive heavy trucking market, and they've executed incredibly savvy acquisitions to utilize their existing infrastructure.
The dividing line between absolute success and total failure here is razor thin.
So what is the immediate milestone we need to be watching for?
The ultimate test will be their upcoming Q2 2026 earnings report. Management has laid down their marker. They have publicly guided for $13.2 million in sales, but more importantly, they guided for an adjusted EBITDA loss of $1.9 million.
Okay, so you're still projecting an operational loss for Q2.
Yes, but context is everything here. A $1.9 million loss would represent a massive sequential improvement, about $2.7 million better than their loss in Q1.
That's a big jump.
If they hit that specific 1.9 million number, it mathematically proves their cost-cutting is working and the runway to Q4 profitability is real. If they miss it, the liquidity fears are going to compound rapidly.
It is going to be an absolute nail-biter for anyone invested in this space.
It really is. And, it leaves us with something I think everyone should ponder, looking beyond just the immediate financials.
What's up?
Consider this. If Dragonfly's strategy actually works and OEM integration becomes the ultimate defensive moat for battery manufacturers, will we see a future where legacy consumer RV brands entirely lose their identity to the technology inside them?
That is a really interesting way to look at it.
Think about the personal computer industry. Very few people buy a laptop for the plastic exterior, right? They buy it for the Intel inside.
Yeah, the processor matters most.
If power systems become the single most critical component of off-grid travel and heavy trucking, will buyers eventually stop caring if the vehicle shell is an Airstream or a Peterbilt and only care if it has Battleborn inside?
Well,
when you look at distress situations like Dragonfly, you really have to ask yourself, is the market severely mispricing the company's long-term future, or are you underestimating the brutal reality of cash flow in the present?
that is the multi-million-dollar question. Until next time, keep digging.